of you to my session, that is learning community. School of Accounting is organizing this particular event. I'm member of that community. So I have been assigned the task of taking few classes on accounting, exclusively on cost accounting, financial accounting, and corporate accounting. So I request all the students, whether it is plus three, whether it is PG, or if you are doing any professional course, so all of you participate in this type of session so that you can learn certain things which are not covered in the classroom, and you may not cover that in your day-to-day study. As our Professor Ranjan Kumar Bal was telling, students fail in answering questions in the interview. It is fact. Even if you know things, but sometimes you fail to answer. Reason is you are not familiar with different types of concept, connotations, and fundamentals of the subjects you are reading in plus 2, plus 3, PG, or in higher classes. So the basic purpose of taking this particular event is to make you familiar, is to make you simply comfortable with the different subjects of accounting. So let us start our session today. I think all of you know topic was given to you 2 3 days back. Uh, this is about uh, tools and techniques of management accounting. I think all of you know there is a diversification, or simply say diverse, between management and ownership in a company form of business. I think all of you know that in company form of business, ownership remains with the shareholders, those who invest in purchasing shares, and management remains in the hand of a group of persons selected by shareholders. We call them board of directors. So the management is one, another is ownership is one. But if you see that sole trade partnership, ownership and management mostly remain with the owner, the person who invests money in the business. But in company form of business, so there is a diverse between these two. The reason is ownership does not remain with one place, because shareholders across the globe invest money in the business. So it is difficult on their part to manage the business. At the same time, shareholders are not competent enough, professionally not competent enough to manage the business, or they may not have sufficient time to give it to the management of the companies. So because of so many drawbacks, reasons, or limitations, ownership remains with shareholder, but the management task is assigned to the management group of people, that is called board of directors. Why I am telling this is that so management is done by the outsiders who are selected by the owners. The success or failure of any organization all depends on the decision taken by the management at different point of time. If the decision taken is accurate, correct, relevant, so definitely business will succeed. So success of business depends on correct decision taken by the management. So management is also accountable to the shareholders for the activities they perform during a particular period of time at the end of the year. So that is why management has to do their managerial activities in such a way that the resources, the money, the funds they have, that is limited, scarce. So it cannot utilize recklessly, arbitrarily, without any base reason. If you invest your money in the business, that will not give you the required return. If the required return is not sufficient, it is difficult to sustain the business. So sustainability becomes a problem for the business. That is why management takes the help of some information, whether it is financial information, whether it is non-financial information, both. They take financial as well non-financial information to take managerial decision. If you tell me what is the example of managerial decision, I can give you one example. Suppose uh, in the competitive business world, you want to fix selling price for a product which can be sold in the market. Of course, you have to maintain quality of the product. So what should be the selling price? Management has to decide it. That is called product pricing. While pricing the product, management collects information and process that information, analyze that is information, then interpret that information and take a final decision, the price at which the product can be sold in the market. So that is why management accounting comes into the picture. Management accounting is a tool in the hands of management. So management uses management accounting information as a tool to take managerial decisions. So my topic to be discussed today is about tools and techniques of management accounting. How tools and techniques are used by management accountant in taking different decisions. So let us come to the first managerial tools and techniques. I'll tell you all the tools and techniques at a stretch, then we'll go one by one. So all of you have read it in your plus two, plus three, PG, or in some higher classes, more or less about the tools and techniques I am going to discuss today. But you must understand briefly today. I can't cover it in 1 or 1.5 hour, all the tools and techniques, because what I'm going to cover today, it is all about the subject of financial accounting, subject of cost accounting, as well as subject of management accounting. So management accounting collects information from cost accounting as well as from financial accounting and process them. Again, that in processed information is analyzed, then they are interpreted, analysis made with the help of different tools and techniques. Then again, we use different tools and techniques for interpretation. You may ask me, what is analysis, what is interpretation? So analysis is uh, about establishing a relationship between two or more variables of your financial statement. Your financial statement covers about assets, liabilities, capital, income, expenses, profit, and other expenses or other information. All these informations are related to each other. For example, it is about current asset, current liability. The relationship tells you about the working capital position of the business. So analysis is about establishing the relationship between the different items of assets, liability, capital, income, expenses, and profits in such a way that we can understand the figures better. And those analyzed figures again are interpreted with the help of statistical tools to take the final decision. So that is why you have to understand each tool and technique of management accounting which is used by management accountant while planning, decision making, controlling the business activities. What are those what are those uh, techniques? Let us understand one by one. First one is financial planning. So students, give your attention to what I explain so that you can understand, you can use your time productively. So the 1 hour or 1 hour plus the time you are spending for uh, this purpose can be uh, that is can be good for you. So let us understand financial planning in one sentence. You see the slide, listen to me, it is both way correct and that will help you. If you see the balance sheet of a company, it consists of three things. One is assets, one is liabilities, one is owner's equity, that is called capital. So all these three, we have an equation that is called accounting equation. So asset is equal to liabilities plus owner's equity. What is the meaning of this accounting equation? It is about financial planning of the company. How? When you plan about the finance of the company, the first step is to know how much money you need for your business. So when you start a company, you need to know what is the capital required for your company at the time of incorporation. I think all of you know the authorized capital required. So authorized capital required means the maximum capital required, which can be raised through issue of shares. Similarly, capital can be raised from debt, securities. So that is why two sources are available. One is owner's equity, another is outsider's equity. When these two equities are there, so your purpose must be how much of owner's equity, how much of outsider equity, it may be short term, it may be long term, should be used in the business. So first point to decide is about capitalization. It is about amount of capital you need for your business. How can you determine the amount of capital you need for the business? It depends on the assets where you want to invest your money. So asset side, we have non-current assets. So that is about your fixed assets. Another is current asset, that is your liquid assets. So you want to invest your money in either current assets or fixed asset or in both. So when you invest, so investment determines the amount of money that you need for your business, that we call capitalization. So that is called financial plan. You have to make a plan for that. So similarly, after capitalization, the amount of money you need for the business, once it is calculated, next step is where from that money should come. So one concept is there, one is financial structure, another is a capital structure. So financial structure is about the entire liability side of the business, that is owner's equity. One is a non-current liability, another is a current liability. The current liability, money comes from current liability, short-term source. Money comes from non-current liability, that is long-term debt. Then money comes from your shareholders fund, that is equity and reserve surplus. All these three together constitute the financial structure of the company. So management has to decide what should be the financial structure of the company, so that resources management raises can be utilized productively to achieve the goal of the management. So that is called financial structure, consists of three. One is owner's equity, another is non-current liability, another is a current liability. But we are more worried about what? Fixed assets. So fixed asset is a source of revenue, that is those assets generate revenues for the business. But current assets do not generate revenues, they rather they maintain the revenues. So that is why fixed assets are generally financed from long-term sources of finance. That is owner's equity, another is a debt source. So debt and equity, these two combination, we call it capital structure of the company. So capital structure of the company is the one of the fundamental, or you may say integral part of your financial planning, which creates value for the firm. The value of the firm is directly related with the capital structure. Capital structure is strengthened, your value of the firm will increase. Value of the firm depends on the amount of revenues you earn from the business. So that is why financial planning is very important about your capitalization, amount of money you need. Then next question is the money will come from where? It will come from equity, debt, and current liabilities. Then next is how much should be equity, how much should be long-term debt. So this is about capital structure and management of capital. So that capital again is invested in your fixed assets and another is in current assets. So fixed assets generally are financed from your debt and equity, but current liabilities are financed for working capital, and part of your debt and equity may be financed for working capital. But we cannot invest certain finance for your fixed assets. That will create a liquidity crisis in the business. This is all about, it's not all about, it is simply few things about financial planning. So financial planning means identifying the amount of capital required for the business, again determining the securities we must issue to raise that finance, then the ratio in which that will be issued, that is called capital structure. All these decisions are taken by the management with the help of the management accounting information. So let us go to the second part, that is more or less all the students of commerce plus 2 or plus 3 or PG, they know more or less about this financial statement analysis. What is this financial statement? It is about the final product of the accounting. So that is your balance sheet, that is your profit loss statement, that is your cash flow statement, another is statement of change in equity, and another is notes to accounts. So all these statements together constitute financial statement, which shows the financial strength or weakness. All these statements shows the performance of the business. Thereby, you can decide what to do, what not to do to remain in the market, to sustain in the market. So financial statement analysis are done with the help of various tools and techniques that you have read in your plus 2, plus 3, or even comparative statement analysis, common size statement analysis, ratio analysis, trend analysis, funds flow statement, another is cash flow statement. All these together constitute financial statement analysis. Again, I am repeating, financial statement analysis is done in order to know the financial strength or weakness and financial performance of the companies or operational efficiency of the companies. So that can be done with the help of different tools and techniques. One is comparative statement analysis. One is your common size statement analysis. Next is your trend analysis. Another is ratio analysis, funds flow analysis, another is cash flow analysis. So let us understand briefly one by one. One is comparative statement analysis. When you say comparative statement analysis, it is statement analysis of balance sheet, statement analysis of income or expenses of the business. So let us understand how does it help the business to take a decision. For example, in balance sheet, we know our equity, that is capital of the companies. So last year equity was how much, and this year equity is how much equity has increased. So that increase or decrease will tell you the progress of the companies. Progress means it may have upward trend, it may have downward trend. So that increase or decrease of items of balance sheet, items of income statement will tell you the progress of your financial position, progress of your financial performance or operational efficiency of the business. Take example of let's say sales. Sales of last year is 100. Sales of this year is 120. So 20% has increased. If it has increased, is it because of your decrease in selling price, or because of uh, quality of product you have sold more, or it is because of cost of that product is less? So all these reasons you have to analyze for increase or decrease in the item of balance sheet and item of income statement. So what is done in comparative statement analysis? Two or more years figures of balance sheet, income statement are taken. First year, second year, you may say, suppose 2018, 2019, two balance sheet you can take, and two balance sheet, again two columns will be there, one for amount of assets and liability, another amount for assets and liability of two different years. Then increase or decrease. That increase or decrease will tell you the progress or downward progress or upward progress of your business, and percentage increase decrease is calculated to know exactly the relative uh, value of the business. So statement, comparative statement analysis, you may say, can be done inter farm comparison you can make, or an intra farm. Inter farm means it is between two different periods of same companies. Intra farm means that inter farm, one company with another, then within company, that is intra farm. Then you can we can call it as what? This is a new concept. I think all of you know that, those who are doing research. One is the time series analysis, another is cross sectional analysis. When you say time series analysis, one company over long period of time, this is called time series analysis. If you take many companies at a time for one period, let's say 2020, we have taken 20 companies to know, that is called cross sectional analysis. So again, if you combine these two, that will give you panel analysis. That is not required for you, but you must understand. So you can compare your performance with the past performance. So that is called inter-firm comparison, intra-firm comparison, that one year with another year, and one company can be compared with another company, of course, similar nature. So that is called inter-firm comparison. Common size statement. So I think all of you have read it in your plus two, plus three. So total assets is taken as a base 100. So all other assets are expressed as percentage of total assets. So that can give you the idea about how much money has been invested in which assets. If let's say PPE, all of you know that, property plant equipment. So total assets is 100, PPE is 60. So 60% of total asset is invested in your PPE. So PPE is the integral part of investment of the company. We should try to exercise control over that. Suppose inventory is 2 out of 100. So inventory percent is 2%. So 2 is very less insignificant. So in that case, inventory investment is less. So we should try to exercise least control over the inventory. So common size statement, so that gives you idea what is the percentage of each item of assets liabilities from their base amount. Base amount is, in case of balance sheet, total assets is 100. In case of liability side, total liabilities is 100. Similarly, in case of income statement, total sales is taken as a base 100, and all other items like your operating expenses, non-operating incomes, whatever are there, all these are expressed as percentage of total sales, so that you can know whether gross profit margin is sufficient to meet the objective of the business or not. That is common size statement. Another trend analysis, I want to cover all these portion quickly so that we can discuss important points taking in detail particularly. So trend analysis is about uh, simply analysis of different years figures, whether figures of different years, whether it is a increasing trend or decreasing trend. When it is increasing, decreasing trend, so in that case, first year figure is usually taken as the base year. So that figure is taken as 100. Other years are expressed as percentage of first year. So that will give you idea about whether past information that or past performance is was better or the future performance or the present performance is better. If it is an increasing trend, so we can understand that our future is good. If it is in decreasing trend, so we can uh, conclude or you can simply finalize that our business is not doing good. That is why it is in decreasing trend. So increasing, decreasing trend will tell the progress of the business. At the same time, sometimes it is fluctuating, sometimes it is increasing, sometimes it is decreasing. If it is increasing and decreasing, then the reason for that you have to analyze with the help of different tools and techniques that you will be taught in future course of time. Another is ratio analysis. I will not again take much of time. Ratio is simply the relationship between two figures of balance sheet or profit loss statement. If you take two figures, let's say one figure is return, another figure is capital invested. So return on capital invested will give you idea whether that return is adequate on the investment made in the business. So sometimes we invest more, return is less, that is called overcapitalization. Sometimes investment is less, but income is more. In that case, under capitalization. So you have to decide what should be the investment in our business. So the ratio analysis will give you about profitability ratio. Activity profitability ratio is about the profitability condition of the business. It is return on assets, return on equity, return on capital employed, EPS, I think all of you know, earning per share, dividend per share, price earning ratio. All these ratios will tell you the profitability of the business. Another is management efficiency ratio, or you may say asset management efficiency ratio, that is called activity ratio. So when you say activity ratios, it determines how efficiently assets of the business are used in the business. I can take one example, that is inventory turnover ratio. Inventory turnover ratio, you know, that determines how many times, how simply how your inventory is converted into cash, how much time it takes to be converted into cash. If it gets converted into cash very quickly, that means your inventory is used in the business uh, efficiently. So we should invest more and more money in inventory. If inventory turnover is very long, it takes long period of time to be converted into cash. In that case, your inventory remains idle in the business. So unnecessary money is blocked in inventory, which could have been invested elsewhere, which would have earned some money for the business. That is why inventory turnover ratio is calculated. I can also tell you another example. Let's say PPE turnover ratio. What does it mean? PPE, property, plant, equipment. So it is the biggest investment in the business. Whether plant, property, equipment is being used efficiently or not, if that turnover is calculated, so the higher the turnover ratio, better is the efficiency of management. That means your assets are being used properly in the business, that can give you more revenues, which can add value to the bottom line of the business. So what is bottom line? That is not only profit, rather it is profit, it is society, it is environment. So these three triple bottom line, that is we call triple bottom line. So these Three, bottom line can be strengthened if revenues are maximized. Revenues are maximized only when you utilize your assets in the business very efficiently. How can you know your assets are being utilized efficiently? By calculating activity turnover ratio or simply efficiency ratio. That will give you how efficiently management is using the assets of the business or investment of the business. Similarly, another is solvency ratio, another is or that is called leverage ratio. So when you say solvency ratio, it is about whether you are able to meet the long-term loan payments and interest thereon whenever they becomes due in future. Suppose you have got loan by issuing debenture. When debenture is redeemed, you must have sufficient fund to pay the amount of debenture. If you have got loan from the bank, you have to pay back that loan in future. So you have to see whether you have sufficient fund to meet that loan or not. So similarly, interest is payable regularly on loan or debenture. So this is what you must calculate whether your profit is sufficient to pay the interest on loan or debenture or not. So that is the interest coverage ratio is calculated. When debt equity ratio is calculated, again assets and debt ratio is calculated. All these ratios tell you whether your business is solvent, whether your business is solvent or insolvent or is going to be insolvent in the future. So solvency is about your debt equity ratio. It is about your debt total asset ratio. It is about your equity and total assets. So higher the percentage of equity invested in your total asset, better is the solvency because your own money is being invested in your total assets. If business is liquidated, then you need not pay them to the shareholder. Reason is shareholders are the final receiver of the company. So if there is surplus, they will receive. If there is no surplus, they bear the loss. But debenture holders and debt holders, they are the outsiders. Their money has to be paid. So that is it. Less the debt, it is better. But more the equity, it has to be ensured so that the solvency ratio or solvency can be maintained. Another is liquidity ratio. I think all of you know. If you see the banking companies these days, so liquidity is the main problem for banking companies. The bank has a lot of money with lot of cash with the bank. Bank has a lot of money. So what they are doing, they are simply sitting idle on that cash. So if they keep the cash idle in the business, it is a loss to the business. They have to give loan. If they give loan to the outsider, there is no investment avenues. There is no profitable avenues. So loan is not demanded by the market. Yeah. So in that case, if the loan is taken, then there is a possibility of NPA, non-performing assets. The assets which do not earn revenues or simply the assets which is not paid by the simply borrower to the bank in due course of time. So that liquidity ratio, so liquidity is the main problem for every company, for every financial, non-financial company. You have to maintain sufficient cash or liquid assets so that you can be able to pay the money whenever it becomes due in short period of time. So these are the things you have read in +2, +3 physics, but it is a big chapter. If you go through that chapter, you can learn in detail. So next is funds flow statement. Briefly, I can tell you three things. As Professor Ranjan Bal was telling, students fail to answer few questions in the interview. What is the reason for that? You do not understand the exact meaning of that concept. For example, if somebody will ask you what is the meaning of fund, what is the meaning of cash, what is the meaning of cash equivalent, what is working capital, what is current assets, what is simply current liabilities, what is liquid assets. So all these are conceptual aspects. Funds here we mean working capital. But generally, funds in general term, if you ask me as teacher of commerce, funds means the resources we use in our business. Our resources may be money, maybe material, maybe machines, maybe anything that we use in the business. But here in case of funds flow analysis, funds means your working capital. So working capital, when you say working capital, it may be gross working capital, it may be net working capital. But we mean here the working capital, excess of current assets over current liabilities. Any transaction in the business, how can you know there is a flow of funds? I'm repeating, students, how can you know there is a flow of funds in a transaction? I think all of you know, understand the transaction. When business exchange some goods and services between business and outsider, that is transaction. But transaction involves, again I am repeating, transaction involves two idea or two things. One business, another is outsiders. When you purchase assets, outsider is involved, business is involved. It is a transaction. But one aspect is event. Event is not only transaction. Event may be internal event, may be external event. When it is internal event, it is about depreciation. Depreciation we charge on fixed assets. That is called internal event. So this is not transaction. So transaction is something which is related to exchange of goods and service between business and outsiders. So that transaction, how can you identify funds are involved in transaction? My answer is one, and your answer should be also one. Any transaction which involves, repeating, any transaction which involves two aspects, that is, one is receiving aspect, another is giving aspect. These two aspects, if are current, there is no flow of funds. Current asset, current liability, current. Means one is coming, one thing is coming to business current, one thing is going out of the business current. For example, debtor is paid. Debtor is a current asset. Cash is also current asset. So in this transaction, both aspect is current. So there is no question of flow of funds, because any transaction which affect the working capital, that is called, there is a flow of funds. If debtor is paid, debtor is current asset. It is asset is decreasing, current asset is decreasing. Cash is paid, another current asset means your cash, you see, debtor is paid cash. So definitely both are current asset. So both that will never affect your working capital. So similarly, another is cash is received from, let's say sale of inventory. If cash is coming to business, cash balance will increase. Another is if inventory is sold, inventory will go out. So inventory if will go out, inventory means your current asset will decrease. At the same time, another current asset will increase. Your active capital is not affected. Similarly, in case of debtor, when we receive cash from debtor, cash is increasing, current. Debtor is current. Both are current. One is decreasing, another is decreasing. Working capital is not affected. Another example I can tell you. Let's say fixed asset is purchased for cash. When you purchase fixed asset, it is a non-current. When you pay cash, it is a current. Fixed asset will not affect your working capital, but cash will affect your current working capital. When cash is decreasing, your working capital is decreasing. So we can say there is a flow of funds in the transaction, that fixed assets purchased for cash. So fixed asset purchased for cash, current, non-current, both are involved in a transaction. We can say there is existence of flow of funds. Again, I'm repeating, students, in the interview many times, we ask students, how can you identify, know whether funds flow in the transaction or not? Your answer should be very simple and clear, that sir, funds means it is about working capital. When there is increase or decrease in working capital, we call flow of funds. So flow of funds takes place in a transaction which involves one account current, another account is non-current. When you say non-current, it is fixed. Fixed asset, fixed liability. When it's current, current asset, current liability. When two aspects are current, there is no flow of funds. Two aspects are non-current, it is not also flow of funds. For example, issue of share against asset, fixed asset. Share is issued, share capital is issued for what? Fixed asset. Fixed asset will come, your share capital is issued. This share capital is a non-current and fixed asset is a non-current. Both non-current are present in your transaction. There is no flow of funds because it does not affect working capital. I can give you n number of examples. Let's say we pay cash to the creditor. Creditor means current liability. Cash is paid current asset. So current asset, current liability. Current liability is paid. Current liability reduces. Current asset is going out. I mean, cash is going. So current asset decreases. So working capital effect is zero. If your current asset decreases, current liability decreases equally, working capital does not change. So there is no flow of funds. Why this is required for management? Management must know whether there is fund in the business or not. If there is fund, liquidity can be maintained. If liquidity means you have sufficient cash, current assets to pay the money as and when it becomes due. So there is no liquidity crisis. So you know the dividend policy. Dividend is paid out of the profit. Is it true? Yes. But if there is no cash available, dividend cannot be paid even if there is profit in the business. Interesting thing. Huge profit is there. But a company is not paying dividend. Reason is company is not having funds, cash to pay that dividend. So that is why dividend is always paid in cash now. So dividend cannot be paid unless there is sufficient cash, even if there is huge amount of profit. So that management has to analyze and interpret whether funds are available or not. That's why funds flow statement is very important from managerial decision perspective. I think all of you understand me. I hope you must be getting what I explained. Funds flow statement. Two things are very important. One is working capital, another is funds flow statement. Two statement we prepare. You know that. Go to the next one, cash flow analysis of cash flow statement. I think accounting student, you know, Indian Accounting Standard, India 7, that is IS, International Accounting Standard 7, deals with cash flow statement. I think all of you know cash flow statement. Cash and funds, there is a difference between these two. Cash is a narrow concept and fund is a broader concept. Fund means it is about working capital. Cash means it is cash and cash equivalent. Some students, plus 3 students, if you do not know what is cash equivalent, it is about a cash which is invested in marketable securities. The securities which can be converted into cash within a very short period of time, exactly in 3 months or less than 3 months. You have cash in your pocket or cash at bank, and you have invested money in marketable securities which can be converted into cash in less or within 3 months. That is called cash and cash equivalent. Cash and cash equivalent is a part of working capital. So funds flow statement does not tell you whether cash is available or not. Funds are available. Cash may not be available. Cash is a part of funds. Funds consists of current assets minus current liabilities. So in that case, cash is very important to be determined whether cash is available in the business so that whenever investment opportunity comes, we can invest our money in profitable investment. Similarly, while taking dividend decision, we have to calculate cash. Another is, I think there is a difference between funds flow and cash flow statement from only from cash perspective. Another is your funds perspective. Another is from funds flow statement is never prepared for different activities in the business. It is prepared as a whole. How much fund is coming, how much fund is going, from the business or to the business, but never tells from which activity it comes and which activity it is used. But here cash tells you the different activities from where cash comes, from to which cash goes. That is why cash flow statement is based on three activities, operating. So it is a revenue generating activities is called operating activity. Revenue generating activities is about current assets, current liabilities. Another is one, your revenue, incomes and expenses. So these all together constitute revenue activities. But another is investment activities, that is your assets. Which asset? Fixed assets or non-current asset is your investment activities. Another is your financing. Financing is about your shareholders fund. Another is about your debt. So these debts and your equity is a financing activities. Another is investment. It is your non-current assets. When you say it is a operating activities, but current assets, current liabilities, incomes and expenses. So students try to understand cash flow statement is prepared to know the cash position of the business at a particular point of time and how that cash position is there, where from money comes and to where money goes. So that is why total activities of the business divided in three types. One activity is operating. It is about your revenue, about your expenses, about your current asset, about your current liabilities. All these together constitute your operating activities. When you say investment activities, it is about the fixed assets, non-current assets like land, building, plant, machineries. All these are non-current. Another is financing activities is about your equity and non-current liabilities. I think all of you understand we prepare cash flow statement from profit loss statement as well as balance sheet. Balance sheet consists of your assets, liability, capital. Assets can be divided current, non-current. Current will go to operating, non-current will go to investment. Similar liabilities, current, non-current. Current will go to operating and non-current will go to financing. Always equity, share capital, shareholders fund is a finance activity. And profit loss statement is about revenues and expenses. They are part of operating activities. So let us go to another part. These are the tools which are used by the management while making analysis of financial statement. But there are few other tools and techniques are there that they are. I'll finish it within 20 minutes. Don't worry. Don't get bored. I think I do not make you all bored. I'm explaining the concept as well as how that concept is used in different perspectives. So then don't get bored. Even if you get bored, drink some water and listen to me. So that will help you. Without taking water, anything I am explaining, without any taking break, I think hopefully all of you are enjoying. Yes or no? Yes, good. So it is another concept is management information system (MIS). So I will not take much of time about this. I think you are a student of 21st century. You know more of technology, how technology is effective in communication. So today you are sitting at different places. I don't know who are sitting where, but still you are getting the information from me, and that will help you to go to different forum to get a job or to score marks. So that is what management information system has to be very, very effective. The two concept is written on the slides. Check operating system, another is reporting system. Operating system is about uh, operational parts and reporting system is about top level management. When top level management, so lower level management, what they do different activities and try to provide those information to the top management. So top management does take the decision. So top management takes the decision on the basis of information provided from the bottom. So that is why reporting is always upward. Reporting is always upward. Your lower level management or operational management or functional management, they always give information to the top. If you are in purchase department, you have to give your purchase. If you are in sales department, you have to give your sales performance to the top management. So operating system and reporting system, if operating system is good, your operational functional areas are good, you are doing your business properly, collecting information and processing them, and you are prepare report, and report is sent to whom? To the top management. So that system, that is called information system. So information system is a system of input, processing, output. So input, processing, output, all these three aspects are done at the operational level, that is operating system. The same is reported to the top to take decision, that is called reporting system. So there is a difference between communication and reporting. In case of reporting, it is always upward. In case of communication, so it may be upward, may be downward. Upward means whenever you have any grievances, you can also communicate to your what your top management. If top management has to give any instruction to you, that is called downward communication. So upward downward is a communication, but reporting system is not downward, it is always upward. You have to report what you have done. So that is why reporting system has to be very effective, that minimizes information. So generally in examination, we do not write all whatever taught in the classroom. We write something which is required as per the question. If you do not know the answer, then you write everything whatever you know. So this is very bad. So that happens if you do not have proper information system. So when you go to examination and you are well prepared and information is properly, it is planned inside your mind, and you answer accordingly. You write the answer according to the question. Similarly, a lot of informations are available in the management. You need not report all the information to the management. So that is why you prepare different statements. One is PL statement, another is balance sheet, one is cash flow statement, another is funds flow statement, another is ratio, another is statement. All these are prepared systematically. Then it is informed to the top management for decision making. Thereby, you are eliminating unnecessary what information that generally brings confusion in the minds of the person who takes the financial decision. And at the same time, if your information system is very effective, cost can be reduced because of what? Wastage of time. Because of wastage of time can be simply eliminated. And if you get the information in time, what you can do, you can take right decision, correct decision, effective decision. So I told you in the very beginning, decision, correct decision, or adequate decision, or simply effective decision, that is the basis of your success of the business. So MIS, on the basis of technology, if you use that, so that will bring proper planning, organizing, coordination, controlling, and all these functions of management becomes smoother and easier with the help of MIS. So next is statistical techniques. I will give you some ideas about statistics. You have read in your plus two, plus three. I think had it been a classroom perspective, I think I would have ragged you all one by one. Since you are sitting outside at the, I don't know which part of the Odisha, so I may not ask question, but I'm answering one by one. In a class, let's say that 40 students are there. Okay, all the students are good students. Okay, let us assume that. But actually, all students are not good students. If I ask question one, two, three students, they don't answer. If I ask 10 students, they answer. So how can you know all the students are good or bad or simply mediocre students? So I have to simply ask one by one. What is this? What is that? What is this? What is that? What is your mark? You have secured in plus 3, plus 2, 10. So on the basis of that, I can decide whether you are good student or bad student. Now, of course, other things are there. I am not discussing. Bad and good student does not depend only the answer you the question you answer or the marks you secure. Other many things are taken into consideration. But my question is, how can you know you are good student, bad student? By putting the question to students. So if there are 1,000 students, can you ask question to 1,000 students? No. Yes, but it will take time. If it is 1 lakh, it's impossible. 1 crore, impossible. So 130 crores people in India. How can you know the average income of the people? it is difficult. You cannot know income of each individual. So that's why you calculate average. That is why given mean, median, mode. So average figure will give you the better idea of many multiple figures. So that is why you have read in your cost accounting average cost, average variable cost, average fixed cost, average total cost. Instead of telling material cost is this much, labor is this much is overhead, and this is the cost of factory X, factory Y. Instead of explaining all the figures, if you explain one figure, that is called average figure. That is called mean, median, mode. That will give you better idea of whether you are good or bad. Another is least square. I can give an interesting example. Can anybody tell me if cost is 10 rupees, how much is fixed, how much is variable? Anybody who can tell? Cost is 10 rupees. How can you identify how much is variable cost, how much is fixed cost? Is it necessary to identify how much is fixed and variable? Yes, fixed cost is usually uncontrollable cost. It cannot be cost. For example, salary. Salary paid to me by the University PG Department of Commerce is fixed. Whether I teach in the classroom, I do not teach, I get my salary at the end of the month. It's a fixed, uncontrollable cost. But if let's say you are constructing a building, and if you use bricks, I think you know ita bricks and cement. So these are what variable costs. If you construct the building, they are used. If you do not construct, they are not used. But if labor is there, if of course labor cost is variable, but salary, indirect cost, mostly they are fixed. So you have to identify how much is fixed, how much is variable, so that you can exercise control. So variable cost can be controllable. If it is controlled, cost can be reduced. If cost is reduced, your selling price will be less. If selling price is less, you can sell the product at lower price in the market. If you sell your product at lower price in the market, then you can have your profit. That is why least square method is there. You can apply to know what is fixed cost, what is variable cost. Suppose y is equal to mx plus c. Y is equal to mx plus c. What is y? Y is, let's say, total cost. What is mx? X, let's say, output. M is variable cost per unit. C stands for, let's say, fixed cost. If you take this equation and another equation you take for two uh, years figure, solve this equation, you can get what is variable cost, what is fixed cost. So variable cost, fixed cost can be identified, can be distinguished. If it can be distinguished, definitely you can exercise control over the cost. That is called variable cost. We use the least square method there. Another is regression analysis. I think all of you know that. Correlation and regression. When you take a decision, we have to first establish a relationship between the two variables or two or more variables. If they are related, then we calculate, then if they are related or not, we calculate what? Correlation. Correlation between variables. Once it correlationship is established, whether it is a positive correlation, it is a negative correlation, then we find out the impact of one on another. So what impact of one on another, that means one is dependent, another is independent. So price is a function of demand. You know that. Price is a function of demand. So price depends on demand in the market. If demand increases, price will increase. Demand falls, price will fall. So y is equal to a plus bx. Y is dependent, x is independent. So here demand is independent and your price is dependent. So you may say profit is dependent on sales of the business. So profit is a function of sales. So profit is a function of utilization of your assets. So to know the impact of one variable on another, dependent variable who is independent variable. So in that case, we use the regression analysis. So management accountant uses regression analysis, correlation analysis to know what impact one has over another. Thereby you take a decision accordingly. If you take example of, let's say, capital structure, I explained in the second slides. It's about debt equity ratio. Does it affect the bottom line of the business, profit of the business? Yes or no? So that is what we have to calculate correlationship between profitability and capital structure ratio. So capital structure ratio determines profitability. Is profitability dependent on capital structure of the company? That can be determined with the help of correlation and regression. So there are so many examples where you can use your correlation, regression, least square method to find which variable impacts which variable and how much. That will help the management in taking the correct decision. I have used also some operational research techniques. LP. LP means linear programming. What is that programming? It's a technique, operational quantitative technique, which helps the management in deciding how much we should produce to maximize our profit and minimize our cost. So this is linear programming. Here one technique is there. It's impossible to tell you the mechanism of using that linear program model. This much I can tell you. It is called uh, uh, value optimization. Optimization problem. Optimization problem means profit maximization, cost minimization. If you minimize cost, if you maximize profit. So both cases are solved with the help of linear programming model. So how much units of a product or how much units of different products we should produce under different constraints, conditions to maximize profit or minimize cost, that we can do that with the help of linear programming. And another is POT and CPM. And I think all of you might not have known about it if you're plus two, plus three students. PG students might have idea about this. Program evaluation review technique. What? Program evaluation review technique. CPM critical path method. These two are important tools in the hands of project manager. The manager who is doing a project. If you are doing a project, your very problem is how within how much time or simply in how many days, in how many years the project can be completed with least cost, less cost, within less time, how your project can be completed. To know that, use program evaluation review technique, critical path method. So that technique will give you idea of how you can finish your project within how much time, at the same time how much least cost can be incurred to complete that in the given time. So these are the statistical techniques management accountant uses in taking managerial decisions. Students, these are simply not this much. Each concept is a topic or subject, simply one chapter. So you need to know more about that in future, or even if you do not know that in your classroom, even if it's taught in the classroom, go through each chapter, you can know in detail. These are techniques generally management. If you want to do job in any company as a manager, so you must know all these techniques, because if your assistant will tell you, sir, I have used linear programming model to know the maximum profit, minimum cost. As a manager, you do not have idea about LP. Yes, yes, tell about that. So you'll speak like that as a layman. So you should not be a layman when you are manager. You must be expert so that you can ask if this is the amount of money invested, this is the profit. So you can increase the profit by this one also. This is what you must know as a manager of a company. Next is management reporting. I have already explained. So it is reporting of profit, reporting of cost, reporting of assets, reporting of liability, reporting of incomes, reporting of capital, anything of business, that is financial accounting reports, anything that is reported by cost accounting. All these two reports are prepared, consolidated by the management accountant. Then it is reported to the top management for policy formulation or for managerial decision making purposes. I mentioned some reporting principles. While preparing reporting for the management, you must take into account the following what points. It is one completeness. When you write answer in the examination hall, it is not complete at all. We do not understand from where you start and where you end that. That's why you get less marks. But you complain that you are getting less marks. It's not like that. It must be complete. Start from the beginning and end. It must end at the conclusion. So it must be complete in all respects. Another is legitimacy. You do not prepare a report arbitrarily. You must follow the rules and regulations. Within keeping the rules and regulations or staying within the rules and regulations, you have to prepare the report. The report has to be prepared as per the law. It's not that you should prepare on your own. Friendliness. Of course, I am friendly to all of you when I explain. I don't scold you when I explain to different concept to you. So that friendliness means you can understand it easily. If something is given, you are not able to understand. So you can, here is a difficult teacher to understand. So it's not difficult on a teacher to understand. Rather, teacher is not able to make it simple. That's why a difficult teacher means he's not able to make it simple. So that is why you must explain the report in understandable manner, which can be understood by the management, even if they are not expert. Reliability, I think, no, reliability and relevance. One is reliable, another is relevant. Reliable only when you follow the rules and regulations, and relevant if it is timely. If you do not provide information at the time of requirement, I think it is relevant. Suppose at the time of examination you do not know answer, so it is irrelevant for you. When you come out, I could recall that yes, this is answer after the exam is over. So that will not give you marks. So that is why answer is relevant if you write in the examination hall at the time of requirement. So at the time of requirement, the report has to be given. Consistency, yes, reports should be given a particular format, in a prescribed format, should not vary from time to time. So that creates confusion. And comparability, timeliness, I explained. So another is standard costing. I will not take much of time because standard costing I explained in the last class. Standard cost has to be determined. Actual performance is to be made. So actual cost will be compared with the standard cost. If there is any difference, that we call variance. So variance may be positive or negative. If it is positive variance, it's good for the company. If it's a negative variance, your standard cost is less, but actual cost is more. So you have to make remedial measures to rectify the standard costing. You have to follow to control the cost. Marginal costing, another costing we have also explained in the last class, is about variable cost. So when you take a decision about whether to produce a product or not, whether to introduce a new product or not, whether to buy the product from the market or to manufacture that product in the factory, whether to use new machine, or we'll go with the old one, whether we'll go for different products or we'll go for one product. All these decisions are taken by the help of marginal costing as well as cost volume profit analysis. This is about contribution. This is about PV ratio. This is about break-even point. This is about margin of safety. So every company wants to know what is the break-even point, the point at which there is no profit, no loss. If you do not know that and you start doing business, so in the gestation period, you understand, in the initial years, you lose money. Reason is you do not know when there is a break even. So that is why if you know that this is the break even point, then you start producing that amount of goods so that there is neither profit is there nor loss is there. So after that, if you produce and sell the product, so there is a margin of safety. So margin of safety is excess of sales, actual sales over your BP sales. So BP sales, the sales where you don't have profit, don't have loss, and that will give you idea from where you have to produce the product so that you can have profit in the future. So these are things you have covered in class 3 in management accounting. Budgetary control, I think I have explained the first class. Budget is prepared for every operation of the business, but a standard cost is prepared for element of cost. Standard cost for material, standard cost for labor, standard cost of overhead, but budget we prepare for purchase, for sales, for production, for every operation of the business. So budgeted cost is based on estimated cost, but which is based on past as well as some adjustment is made to the past information, keeping in view the future trends. So standard cost is not like that. It is simply scientifically estimated cost. Budgeted cost is a method of controlling cost. Standard cost is a method of controlling cost, but budgetary control is different from standard costing method. Reason is standard cost is scientific, budgetary is not so scientific, but it is done to control the cost by simply telling the people, yeah, this is the cost available for you, and try to spend that cost up to that level. So this is how budget is prepared for our country. Also, finance budget every year it is prepared by finance minister and placed before the parliament, and all the expenses are incurred up to that budgetary figures. You cannot spend more than that. If you do that, then you have to prepare or simple. You have to reschedule the budget, or revised budget has to be prepared for that. So another is revaluation accounting. It's very interesting. I think a tough one. India 16. I think all of you know India 16. PPE, property plant equipment. Index 16 allows revaluation of assets and liabilities. So if you revalue your I think in accounting we have read our assets are shown at a book value. What is the book value? Assets original cost minus depreciation. Original cost minus depreciation, book value. But assets these days are shown at revalued figure. When you say revalued figure, we value the assets. So that is why we follow Ind AS 113, Indian Accounting Standard 113. That is IFRS 13. So that gives you fair value accounting, fair value measurement. What is the value of assets today? So that is not possible now in our market unless it is a competitive market. So assets when valued, revalued, usually increase. There is always increase in asset. Of course, there may be decrease, but whenever in inflationary situation, when assets are revalued, so assets increase. When assets increase, the increase in assets, that is called what? Revaluation profit. So that revaluation profit is a part of reserve and surplus. So when revaluation profit is there, your reserve and surplus increases. Your reserve surplus increases, your shareholder fund increases. Your shareholder fund increases, your equity increases. When equity increases, your debt becomes less. Equity and debt ratio becomes what? Different. That's why I've written in the slide, it reduces leverage ratio. Debt is less, equity becomes what? More. It's good for the companies. It's good for company. Money comes from that revaluation. But it is difficult to measure that value. So that is why you follow Ind AS 113. Go through that, you can know. And collateral. Collateral means when you get loan, you have to deposit what? Assets from assets as collateral. When your assets value increases, collateral increases. You can borrow more loan from the business. The loan can be supported by security with revaluation of assets and dividend policy. When you want to pay dividend, then you should pay dividend out of the divisible profit. I think all of you know divisible profit, the profit which can be divided among the shareholder as a dividend. So that is only revenue profit, never capital profit. Revaluation profit is a capital profit, which is part of reserve and surplus. So reserve and surplus is not available for dividend because it consists of some profit which comes from the revaluation. So if you pay that, then you are paying dividend out of capital. So it is against the deterioration or principle of accounting. It is simply deterioration of capital. Capital will come down if you pay dividend out of that. So dividend policy has to be decided if there is revaluation of assets. So impact revaluation, depreciation also. When you asset is revalued, asset value increases. Asset value increases, depreciation also increases. When depreciation increases, your profit also decreases. So it affects the profit of the companies. So at the same time, it increases reserve and surplus. So this is interesting part of this accounting, how assets are revalued, how profit or loss and revaluation are treated. So these are things management account and takes into consideration while showing assets in the report. Assets should be reported not at book value, rather at a revalued figure. And besides all these techniques, I mentioned few techniques. If you see the slides, I mentioned many techniques: responsible accounting, cost benefit analysis, activity based costing, target costing, value analysis, Kaizen costing, social accounting, environmental account. These are the few things we have discussed in the last class. But one thing I want to explain, that is Kaizen costing. I think all this costing and accounting you know more or less. If you do not know, go through that. It is already, I think I have taken 1 hour class, almost 1 hour plus. So responsible accounting, you know, that is the accounting which is where person remains in charge of a particular center, cost center, the place where cost is calculated. A person is kept as in charge of that. If anything happens to that center, the person is responsible for that. That is called responsible accounting. So these days, if I take the example of our education or any institution, responsibility is not there, accountability is not there. That's why work is not proper. That's why India is not growing. Our India is not prospering. Economy of India is not good because we are 130 crores. I think 130 crores, if you work efficiently, actively, and India will become better than America within 1 year. And China is threatening us. So it is because of we people, we are not utilizing our potential. So it's a responsible accounting has to be fixed. So responsibility is the main focus of cost accounting these days. I think you must understand, students, you take the responsibility of your own as well as your family, as well as all the institution where you are doing your course. Cost benefit analysis. I think all of you know, anything you want to do, you have to analyze as commerce students or management students. What is the benefit in if I do this one? Okay. You do not understand the social benefit, rather only the benefit for you, for the organization. Unless organized sustain, I think society will not help you. Of course, social benefits is required, but profit is a must. So profit has to be earned to sustain in the business. So activity-based costing, I think I have told you in the last class that overhead has become the major problem for every organization, because these days manual work is not done. All works are done by the machines or the technology. So that is a maintenance of machine technology is a need of the day. So for that we spend a lot of overhead expenses. So overhead has to be based on activity, and activity determines the overhead. So that is a overhead should not be based on your labor cost, rather overhead should be based on your activity, the work you are doing. Target costing, I think we have explained. Value analysis, Kaizen costing is interesting. It's a Japanese method which has been developed by Japanese recently. The purpose of this costing is to generally what happens, our teachers in the classroom tell us, are improve your what quality. We try to read 15-20 hours a day instead of 5 hours. So earlier we are reading 5 hours, now we are reading 15 hours. You cannot change from 5 to 15 hours immediately. Rather, 5 hours should be increased to 6 hours, 7 hours. So it's just slow improvement on continuous basis. Slow improvement on continuous basis. Improve, but slowly on continuous basis will bring the result to the organization. If you change the entire scenario of organization immediately, I think nobody will sustain you, or nobody will help you to sustain the business. There is always resistance whenever any changes take place. That's a Kaizen costing. It's good costing. I think I accept this method, that if you want to improve, improve slowly but on continuous basis. And social accounting and environment accounting, I have told you triple bottom line: profit, planet, people. Profit is a must, but planet and environment has to be taken care of. Because of that, coronavirus is there, everybody is suffering, and we are suffering because of the environmental problem. So every company, every country has to take care of that environmental aspect. Another is social aspect. We must help each other, the society, the poor, the needy one, so that together we can grow, together we can sustain, together we can achieve more. But profit is required. Without profit, we cannot sustain as a businessman. But profit should not be the sole objective of the business. Rather, your objectives should be triple bottom line: profit, planet, people. Triple bottom line: PPP. Economic, social, or simply society, another is environment. Hopefully, you must have understood me, whatever I explained. over 1 hour the techniques, tools that, that we use or by used by management account and in day-to-day management of the business. So these are the tools and techniques, but this is brief discussion I made, but onus is on you to understand it in detail by going through the different chapters. Thank you very much for your participation and for your simply showing your interest to learn from this learning community and School of Accounting. And we must thank also DSBN for providing this platform to interact with all of you. Thank you very much. Again, we'll meet on another class with another topic. Thank you. Thank you. Where is stuff? अनम्यूट जो हिट चला है तो अनम्यूट करेगा क्या क्या मारो रमणा सर अच्छा नहीं फिल्म मजरे जॉइन कर so any students who want to speak hello what
Sir,
anyone want to speak anything to us
sir, which one is a broader budget control or standard costing?
uh,
Which is a broader sense?
yes, budgetary is a broader one because
Okay.
budget is prepared for different operation. Let's say budget is prepared for the organization as the whole. Budget is prepared for the department. Budget is prepared for section. Budget is prepared for the function. But standard cost or standard costing is maintained for elements of material, labor, overhead, and sales. So that's why standard costing is a narrow and budget is a very big. Okay, thank
Thank you.
you. Okay, we'll stop it now.
Okay.
Thank you very much.
Thank you, sir.
Thank you all.
Thank you.
Thank you. Thank you.